Good afternoon, Pratik.
Good afternoon.
Shall we just wait for a few minutes for some more participants to join in?
Yeah, sounds good.
We'll just give it another 2. Chicago Board of Mercantile Exchange, etc., and some other larger investors. In economics, and then he's subsequently done his MBA from the London Business. And why it's essential that they should rejig their investment strategy or make some foreign portfolio. Pratik, how do you propose we go about it? Is there something that you would like to share with us in terms of presentation? Is there some data which you could enlighten us about?
Yeah, sure. So I have a presentation. So I can present it, or we can obviously have a Q&A session too. So if you want, I can start my presentation.
Yeah, I think that would be best. I think you could start your presentation, and during the course of your presentation, if there is something which I think may not be very clearly understood, then please allow me to interject and ask you a question.
Sure. Yeah. Sure, perfect. Thank you, Rakesh ji, and thank you, Keynote, for having me out here. It's a big honor, and I look forward to having a great session with all of you. So the theme of today is international investing. It's becoming, I would say, a relatively large theme over the last couple of years. Having as Rakesh pointed out, I have experience working in multiple markets. I've worked in the UK, worked in the US, and also worked in Hong Kong. And what I've seen in my at least in the last say 10 years is that almost all investors I know outside of India have between 20 to 40% of their equity investments outside their home country. So I saw the similar and even when I was managing money for people in the US about 2 years ago, I saw that similar allocation. And when I did come back to India about 2 years ago, I saw that nobody was really looking at international diversification, which is why I sort of started out with our sort of Nasdaq fund, and we also launched another fund after that. But essentially, it's extremely important because today a lot of our I would say money is in India, which is great. I think India is a great economy. It's growing at a very quick rate. It's one of the fastest growing, I would say, economies in the emerging market space, and we have huge prospects going forward. But overall, I think if you look at India today, it's still extremely small in terms of if you look at the world today. And if you can see the slide, India is only 3% of global GDP market share. We are losing out on 97% of wealth creation opportunities outside of India. And especially in the US, because the US is obviously the primary market, because US accounts for 55, well, now close to 60% of, I would say, global market cap of companies. And American companies tends to be a lot more globally diversified. But we're also missing out on, say, countries like China or Europe and Japan and all of these countries. So essentially, I do believe that there are a lot of wealth creation opportunities outside of India. And even though I think it is quite a small portion or very small amount of the AUM today is outside of India, I do feel over the next 5 to 10 years time, most investors will have some allocation towards international funds or international stocks, whatever there is. There has been an increasing amount of interest in the last 2 years. We have been lucky by having good funds in the international space, and we have now we're now leaders in that space. But we do feel that a lot of other fund houses will be coming up with international funds. So, but more importantly, as I said, I think we are obviously a big country, but we're still very small at in terms of the global GDP market share. And essentially by having equity in India, you're you're not diversified enough. You are susceptible to shocks in the domestic economy, which is what you saw in the last year and and sort of every single crisis. But the biggest reason to why I think people should diversify internationally is because of correlation. So correlation is again a very new term in India. It's very well used term in say developed markets like US and Europe. Whenever someone pitches a new product to a customer, they talk about what is this product's correlation with the equity indices or the equity markets. And the lower the correlation, the better it is, because people understand the value of equity, but they don't understand the value of other asset classes in the portfolio. And essentially today, a lot of us as investors feel that we're diversified if we buy a large cap fund versus a mid cap fund versus a small cap fund. But actually, there's not really a lot of diversification, at all. The correlation or how two asset classes move together tends to be very high for domestic equity. You must have seen it in March of last year. Regardless if you held a large cap fund or a small cap fund, everything was down 60, 70, 80%. So it's not really a well diversified approach by spreading your bets across different mutual funds. I think the correct way to do is to spread across different asset classes. So and equity is one asset class, international is one asset class, debt is one asset class, and gold obviously is now also an emerging asset class. So the correlation of Indian equities, so if you see this slide, you have the Nifty 50 and Nifty 500. And you also have the mid cap and Nifty 500. So, essentially multiple sort of multiple size categories within equities, and the correlations tend to be 90% plus. So you're not really getting a lot of diversification if you're only holding Indian equity. At the same time, there's got yes,
on
yes,
the
sir.
previous slide, I just had a kind of a generic query. So is this correlation only very high during stressful times, or is it equal even during the upward euphoria?
It's across all periods. It's across all periods. We've done, I think I have a better slide in some other presentation where we're looking at correlation across calendar years. So, 21, 22, 16, 17, 18. And it tends to be pretty much the same. So across different cycles, yes, the correlation, in fact, the correlation of multiple asset classes tend to go together in crisis periods. But essentially what we've seen is that, it is quite high across all periods and all sort of all types of market conditions. And we've seen the opposite for international equity. So essentially today, a lot of people are talking about diversification, about reducing risk in their portfolio, and they are going towards debt, they're going towards gold, they're going towards real estate. But the problem with those asset classes is that you're giving up return for lower risk. Those asset classes traditionally have had a lot lower return, so you are giving up returns, whereas international equity is one such asset class where you're not really sacrificing return for lower risk. Returns are pretty much the same. Last 10 years, returns have been a lot better, but risk is a lot lower. So the correlation of say like an S&P 500 index out here tends to be around 20% versus 90% that you see in Indian indices. So they do end up moving in very different directions. So when one does badly, the other one does well. So you sort of equalize and make your portfolio a lot more stable across different market cycles. And we've seen it in multiple times. Even last year, if you had international stock in a portfolio, the direction of movement would have been in very different sides. So I think correlations, extremely important. And the issue is with correlation is that people tend to view, at least today, as US markets as the most prominent markets. Everybody's talking about US markets, but there are a lot of other countries outside the US which are equally important for your international diversification. So I will talk about other areas as well. So the biggest question I get from investors that I understand that international diversification is important, but how do I diversify my wealth? And we have looked at other geographies as well. So we've looked at emerging markets as a theme, and we've looked at developed markets, which is essentially mostly Europe and Japan. So if you have a combination of emerging markets, developed markets, and US, that's a really good portfolio to have in for investors if they're looking at, I think having an international diversified portfolio across all geographies. When I was in the US, almost all my investors had 4 funds in their portfolio. One was, the S&P 500, which I will talk about, which is a broad-based index in the US. You have the NASDAQ index, which is a more tech-oriented index. And then you also have the emerging markets fund and then developed markets fund. So these 4 were pretty much there in everyone's portfolio. and I will be talking about how these four can be really important for people's wealth. But essentially, if you look at I would say two distinct themes when you look at international diversification. One is the US, one is developed markets, and one is emerging markets. Within developed markets, US tends to be a standout. So you have US and Canada, which is essentially the biggest, but then you also have Europe and say Japan. And emerging markets, you have say China, Taiwan, South Korea, Brazil, which are also good markets. So I think this is how at least global investors see global stocks and global funds in their portfolio. But what sort of impact can you see in terms of risk on your portfolio? This is a slightly complex slide, but I'll try to sort of simplify it as much as possible. What you can see is a Nifty 500, which is an Indian index. It's a multi-cap index, and as you can see, this is risk and this is return. The Nifty tends to be not very much in return, at least not in the last 10 years. But the risk is extremely high. So, and if you diversify, if you go from 100% Nifty portfolio to say a 90% or 80% or a 70%, your returns actually go up and your risk is coming down. So your annualized volatility, which is how you define risk by, is actually going down, whereas return is actually going up. So your highest return actually happens when you're holding international equity of say 40% and domestic equity of 60%. So it's a very good graph that shows how diversification can actually enhance returns, but also lower risk in your portfolio, because these asset classes are completely uncorrelated. So I think it's a very good chart that shows I think how you can really diversify a portfolio and essentially get to a place where your returns are high and your risk is low. And I think that is a very important point, because in today's market, I think no one really knows what's going to happen. Both markets are pretty expensive, but I think if you have one market or the other, you will have some risk, some country specific risk. But if you have both in your portfolio, you can expect both to move in different directions. So if one does badly, you have the other one to reduce risk. And this again is a very similar slide that talks about risk reduction. So if you have 100% portfolio, then you can expect a risk to be pretty high. But if you say put a 10% allocation to international equity, you are reducing risk and vice versa. So I think you can see that by allocating more money to your international portfolio, your risk is falling dramatically from say here to what it is. So you can actually get to a place where you only have 30% of the volatility of only holding Indian stocks or Indian funds by allocating to international stocks. I think it's a good I think graph that shows how at every level. I think the yellow one is a 50-50 where you have 50% international, 50% domestic, and you can see that it's coming down dramatically. So it's a good sort of slide that talks about how you can go about diversifying your wealth. Also, once you sort of decide to diversify your wealth, I think it's extremely important for you to figure out how to diversify or how much to allocate to different sort of geographies. And as you can see, it's a very similar slide which says that about 50% is where you can really 40 to 50% is where you can actually look at diversifying. I think a 20% to international equity is a good starting point. But you should look at maybe 20-30%. I wouldn't recommend 50-50 because our understanding of international markets is not very strong. So essentially, if anything bad happens to your portfolio, it's much harder for us to really gauge as to what to do, because our understanding of India tends to be a lot higher. So I do believe that you should ideally have most of your portfolio in India. Also India's growth prospects tend to be, at least over the long term, tend to be a lot higher. But having say 20% or 30% can really help meaningfully to your portfolio when it comes to periods of stress. As you can see out here, the yellow line tends to be where sort of Nifty 500. So these are basically falls in the market at different points in time. And as you can see, if you hold a pure equity portfolio, your short-term falls tend to be the highest. Whereas if you have say a slightly higher allocation towards internationals, you are getting some downside protection in case markets in India do badly. So this is essentially the building blocks, to your global equity portfolio. You have obviously an Indian mutual fund or your Indian sort of, I would say investments. that you can look at. But also, I think a combination of, say, a US market, a developed market, which is Europe and Japan, and also in emerging markets where you have other countries, can be a great sort of solution for all your sort of diversification needs, and really have a nice sort of global portfolio in your bucket. And I'll also talk about, maybe towards the end of the presentation, about what are the other benefits of having a global diversified portfolio apart from just risk, as you can see it. This again shows the risk return payoff of having a globally diversified portfolio. As you can see, over a 10-year period, Nifty has not really done as well as what people had expected with returns. But by adding, say, some part of your global portfolio, you can see that the 9.7 over 10 years has gone up to 11.2 to 11.8 to 12.5. So essentially, you are looking at higher returns, but also your annualized volatility is going down from 17% to 15 to 14 to 13%. So you are essentially getting I would say this very similar point from last time is higher returns, but also lower volatility, and also more consistent portfolio with less sort of with a little bit more downside protection. This essentially is the same thing where in the previous slide I talked about only having a US fund. But if you have these other indices in your portfolio, which is developed markets and emerging markets, the returns have gone even higher. So about 13 to 14%, or even 15%. Look at a 50-50 portfolio. So you are looking at additional returns by having a slightly more diversified portfolio and across different geographies, which I think is extremely important. So people are looking at the US today in a very big way. But I do believe that, so each of these colors is actually a different geography. So, orange is US equity, green is emerging markets, blue is developed markets, and Nifty is red, orange in color. And as you can see from this, and these are essentially the top performing asset classes in each year. So as you can see, 2014, Nifty did really well. And as you can see, 2017 also Nifty did really well. But last 3 years, Nifty has not really done as well. But other economies have done really well. Last year, emerging markets did really well as a geography. So I do believe that it's very hard for investors like us to predict which asset class will do well in the future. So the best way is to just have all four. And by having all four, you're essentially making sure that the best performing asset class is going to be in a portfolio at all times. This really shows that you can't really time the markets. What did in the past will definitely not do well in the future. And the best way is to sort of have a portfolio across these different geographies and ensure that you always have the winners in your portfolio, because the winners keep changing every year, as you can see out here. So that's important. The second and most, and this is maybe a little bit complicated, but I'll simplify it. But the most important thing in finance, or not most important, but one of the most important things, is to continuously rebalance your portfolio. What does that mean? Today, a lot of us, buy what is done well and sell what has not done well. If you look at a lot of portfolio reviews that you do, or like a lot of decisions that you make, you tend to add to your winners and sell your losers, which I think is not a very good strategy. So it's been consistently proven that the winners of yesterday will not be the winners of tomorrow. So the better strategy is to actually buy your losers and sell your winners. And that's what rebalancing does. If you have a fixed allocation to, say, the US, and that allocation goes up from, say, suppose 60% to 70%, most people would actually add to the US portfolio. But actually, the prudent investor would do the opposite, where they would sell US, back to, say, 60% and buy other geographies. What we've seen is that a portfolio with no rebalancing tends to do a lot less in terms of returns than a portfolio that does rebalancing over time. So again, extremely important to understand that rebalancing is super important. And also it helps in reducing risk as well, because you're ensuring that your portfolio is the same and your risk is also the same in your portfolio. So one important point that I haven't mentioned is that buying international investments, you're actually not only buying stocks, you're also buying the USD as a currency. So you're essentially buying two different asset classes in one fund. And the USD, to be honest, is a very important asset class. Today, so I went to study in the US about 10 years ago. And when I went, dollar was I think at 40, 45. Today, the dollar is at 75. And in 5 years' time, it might go to 100. You never know. So what we've seen is that over long-term periods, we tend to the rupee tends to lose value over time. Even though, so if you look at the Nifty returns for a US investor, it's actually negative because that's how the dollar has appreciated over time. So essentially, if I had to say plan for so if I went to my same school and same degree, my cost of education will be 2.5 times than what I paid 10 years ago. And this is only because of because of rupee depreciating. And we've seen that the USD tends to appreciate by 2 to 4% every year. So what you're doing is by buying international funds, you're not only getting returns from the underlying stocks, which are doing well, but you're also getting returns from the INR depreciating over time. So your returns tend to be a lot higher because of this aspect. So again, I think very important point, that USD is a stronger currency, and it is expected to become stronger and stronger in the future as well, at least over the long term. So I think it's good that we should hedge our portfolios, because today a lot of us are buying a lot more foreign goods and services. We are doing foreign trips. We are sending our kids to schools abroad. So we should ideally keep that in mind when buying international stocks, because you're protecting yourself from a weaker. So even though you make really a lot of money in India, from a global perspective, you're actually losing money because your currency is getting devalued. So again, very important, buying international funds or international stocks or international investments, you are buying the currency as well, which will most probably, be a lot stronger in the future than it is in the past. One more form of diversification that you see is not only in geographical but also sector diversification. So India tends to be financially focused, financials and consumer, whereas a lot of the other emerging markets tend to be, so the China or US tends to be heavy in tech. There are a lot of tech stocks which have done really well. You have developed markets which are good in commodities. So you're also getting diversification not only from currency and from the valuation of the index and the movement of the index, but also diversification from owning different sectors in different countries. So we're also getting additional sector diversification through buying these indexes abroad or these funds abroad, which I think is extremely important, because again, that will really help. Suppose financials is doing badly in India, or financial or tech is doing badly in the US or in China, you always have other sectors which offer that form of diversification in your portfolio. Just wanted to, I think, quickly summarize, and then maybe we can, have a Q&A and maybe a chat. But just wanted to, I think before I have a takeaway, just wanted to talk about the broad benefits of having a diversified portfolio of buying international stocks. One is, as I said, correlation. It's important to understand that both these markets, India and US, or India and other geographies, tend to move in different directions. And by adding a fund or stocks in these countries, you're essentially making a portfolio less risky from domestic risk. You're making a lot more diversified, and you're ensuring you're getting some downside protection in case one or two asset classes don't work. The other benefit is the quality of stocks. Today, I think in India, I think a lot of us today, Tata Motors is not only competing with, say, a Maruti, it's competing with a Kia, with a Hyundai, with a Toyota. So I think our consumer patterns have also changed a lot. And, I think all of us are consumers of Apple, Google, Facebook, Spotify. So I think it makes sense that, our investing patterns also go in the same direction. Lastly, the dividend yields in the US tend to be a lot higher than in India. So, for example, the S&P 500 index, it has a dividend yield of around 2%, which I think is really good. It does not sound like a big amount, but if you look at a long-term perspective, so the S&P 500 without dividends did around, I think, 13, 14x in the last, I think, 30 years. But if you add dividends, it's about 27, 28 times. So that's the magic of dividend compounding, something which, it's slightly higher in the US than it is, or in other countries, developed nations, than it is in India. You're getting really high quality companies. Today, we all know that Reliance, TCS are great companies, but I think it's good to have other equally good companies in the portfolio as well. You're getting also currency benefit by having international stocks in the portfolio. So that's essentially 3 or 4 reasons to why you should diversify. I would recommend maybe 15-20% diversification starts to at least that's a good healthy sort of amount to have. I do believe that maybe a small amount of 3 to 4% may not really be significant, because for you to really sort of experience low correlation diversification, it needs to be a substantial sort of holding. If it's just 3 or 4% and it's just some other fund in your portfolio, it doesn't really matter. But if you want it to sort of percolate to the rest of your portfolio, it needs to be significant. Also, I think as I said, over the long run, you will see that your portfolio will be less volatile. And as I said, you will essentially have a portfolio which is moving in different directions. So I think that's pretty much the takeaways from today's presentation. I do talk about the US a lot, but we started to also talk to customers about other geographies, because I do believe that investors should not really chase. US has done really well in the past, no doubt about it, and it has a great future. But I think for a prudent investor, you should also look at it from a more comprehensive landscape, which is why we do believe that you should have sort of money in different markets and different geographies. So that's pretty much my presentation today. So you also, we can open it up for questions now. So you're muted.
Thank you, Pratik. That was a nice, crisp presentation. Didn't really meander too much here and there, very to the point. However, in the interest of the audience, I do feel like asking you a few general questions on what you spoke today. So to begin with, we are not talking about diversification because there is a dearth of opportunities in India. Typically when and I think at this stage of evolution of the Indian investor, if I may say so, I think right now we are looking at some sort of HNI investors who would be looking at international diversification and not really very, very retail investors, is my understanding. And when you talk to HNI investors, typically the answer is, यहाँ पे कोई opportunity की कमी थोड़ी है, बाहर जाने की क्या जरूरत है? So I gather from what you spoke that it's not a dearth of opportunities. It's basically diversification to reduce volatility and risk vis-a-vis the return that you can generate out of the portfolio. And I think you classified global equity portfolios in 3 different silos, one being the S&P 500, and then you've spoken about developed markets ex-US, and then there is the emerging markets ex-India, and then there's India itself, obviously, which is so. The first question that comes up is, typically HNI investors who are going to invest directly themselves, they are knowledgeable, informed investors. And how do they go about assessing things like geopolitical risk, maybe macroeconomic factors, fundamental research on sectors and stocks? Or is there a better mechanism, and do you suggest that they should invest in funds which are doing this for them professionally?
Yeah, I think so. To your point to your first point, actually, in my experience, the growth has come more from retail investors than from HNIs, at least in my experience. So we've had crazy traction, with retail investors. In fact, it was retail investors who started investing in international companies 2 years back, and now I think you're seeing a lot more HNI investors looking to go abroad and I think invest. So I do think that it's quite consistent across at least in our experience across different all types of customers. But yes, as you said, how do you manage risk in terms of the intra geography risk? I do believe that there is by having your money in different geographies, you are essentially taking out or diversifying away all the risk that comes. If I thought US was the best fund of the US market, then geopolitical risk in the US would leave you exposed on that front. But by having sort of a portfolio where you have access to 25, 30, 40 countries, including India, which is your key market, and the reason why India should be a key market, because we really understand the risk out here, and we understand what it takes to make money, and we can accordingly sort of navigate our portfolios. But when it comes to I think geopolitical risk, I think, as I said, the best way is to really sort of diversify it out by having exposure in multiple markets. I think it's not very complicated in the sense that if you have exposure in multiple markets, then one market performing badly will not really affect your portfolio as much. So if you see a lot of I would say fund managers in India, a lot of them have a policy of not having more than 5 or 10% maximum cap on a single stock, because they need to make sure that if one or two stocks don't work out, it doesn't really harm the portfolio as much. So they want to ensure that they have the cap in their portfolios. And I think global diversification is exactly the same, where you should ideally have not a cap, but at least ensure that you are diversified across. That takes away all that geopolitical risk and other things. When it comes to trying to buy the right funds or buy the right stocks, I do believe that at least for us, our understanding of US or even global markets is not that much. We don't understand the underlying economics, the total market potential in those specific countries. So the best way of at least doing it is through, say, passively managed funds. Unlike India, where obviously actively is doing well, passively is doing well. If you look at especially say developed markets like the US and Europe, there you have seen that the performance of passively managed funds are a lot better. It's also simpler. You don't have to worry about choosing from like 10,000 funds. You just put your money in an index and it will do its job. So I think you're essentially don't have that much, I would say, choice paralysis, because in India you have 5,000 options. Globally, you have 1 million options. So I think and we don't even understand, the US. I mean, even I don't understand the US as much. So I think having a simple passive play or any sort of diversified mutual fund is good enough, at least in my and this is also prevalent in the US. When I manage money in the US, domestic investors had 60-70% of the money in these passively managed funds. So if they have so much confidence in the other, then we can say that we can just simply diversify and not worry about performance. And the good thing about index funds is that you can invest them for 5, 10, 15, 20 years. They're not going to change. The S&P 500 has been around for almost 100 years and will be around for another 100 years from now. So I think it's a good low cost, low risk way of getting diversification without having to go out there and choose the right fund.
So when you say passively managed funds, you're essentially saying that basically invest in funds which are replicating the index or following the index.
Yes.
Is that right?
Yes. That's right.
And then what kind of diversification would you recommend across these three different international markets, the US, the developed markets ex-US, and the emerging markets ex-India?
Yeah, so I think one way in which at least global investors do this is to look at GDP of these three markets. So what I would say is 55-60% is primarily US, because of the market cap of US tends to be the highest. So if I had to do it very simple, I would do 60% US and then 20% developed and emerging. Emerging is still extremely small in terms of, I think it's only like maybe 10 or 11% of global GDP, but it's the area where you can make a lot more money because of the growth prospects in emerging markets. So what I would do is to do a 60-20-20 in terms of these three different areas.
And when you talk about developed markets ex-US, essentially, are we talking about Japan and Europe
Yes.
and UK and China? Is that what we're talking about?
Yeah. So China is still an emerging market, but developed markets would be a combination of Europe, EU area, and Japan. Those two would be areas we're investing.
So how much of diversification would you say? Should somebody look at country-specific funds, or should we look at European funds overall? Because so US is simpler, 50%, 60% you put in the US passively managed funds. How do you break up your 20% each in the emerging markets and the developed markets ex-US and ex-India?
Yeah. What I would say is keep it simple. There are lots and lots of diversified, I would say, broad market funds which capture these two geographies. So I would say, look at one fund or maybe a couple of funds in each geography, which is giving you exposure to maybe the top 200 or 300 stocks from that different geography. I think that would be the simplest way of doing it. I wouldn't. I think there may not be any sector bias in each of these geographies, because if you look at it from a multi-country perspective, they are well diversified in terms of sector exposure. So I would say, I mean, maybe to keep it very simple, maybe a top 100 or top 200 or top 300 companies within these two geographies, or at least developed and emerging, can be a good way of getting exposure to the best performing asset classes, or the largest companies. And what we've seen is that the largest companies tends to be a lot more stable over long periods of time. So that's maybe funds that invest in these sort of companies would do fairly well.
So, Pratik, you also spoke about rebalancing in your presentation. So, how would, if let's say I'm putting my money 50, 60% in, so international exposure, maybe I allocate to begin with 20%, maybe 30, 40%. And of that, 50% is in US and the rest is between these other two geographies. How do I rebalance? What do I do to rebalance? Do I need to switch funds? Do I need to move from one fund to another? So these are very operational questions in general, but I guess people are grappling with these issues. In fact, subsequently, I'm going to come to ask you a few more other operational issues. But right now, I'd like to understand, how can one rebalance?
Yeah, so rebalancing is, I mean, what I have seen is the most common way of rebalancing. So people do like weekly rebalancing, monthly rebalancing, yearly rebalancing. So what we've seen is that it doesn't really make a difference if you rebalance a portfolio once a week or once a year. The returns are pretty much very similar. What I would recommend is to do it once a year. And by that, what do I mean? But if, say, you have a 60% exposure to the US, and if US is a huge sort of bull run or run up, and the 60% becomes, say 70% over a year, then I would recommend selling the US and buying the other two countries, the other two geographies, to ensure that the US falls back to its 60% exposure. So I think that's, so there's always a question, when do I sell my mutual fund? And my clear answer is that you sell when you have to rebalance your portfolio. So, when you have a certain asset class in a portfolio which is run up, most investors do the opposite, but most investors tend to add on, because of FOMO. But I think the correct way to do it is to actually cut your equity, or cut that specific geography which is doing well, and buy the geography which is not doing well. Because what we've seen is that things do not end up, I would say, increasing in the same direction over long-term periods. So there's always some rotation happening. And by rebalancing, you're ensuring you're making sure that for each rotation, your asset allocation is completely consistent. So that's what I would say. It's pretty much, there's like countless of studies that have been done, but talks about really the effectiveness of rebalancing. And I do think that investors should do it in India as well as for their abroad exposure. So a lot of investors who have seen this bull run over the last 1 year, who are seeing their equity positions becoming larger and larger, should ideally look at going back to what their allocation used to be, and making sure that it's consistent, because that I think is the best way of really creating long-term wealth. In fact, we've done studies which says what happens when you keep on buying last year's best performing asset class. So there's 4 broad asset classes: equity, debt, international, and gold. And if you keep buying last year's best performing asset class every year for 13 years, your returns are about 7.9 or 8%. But actually, if you buy last year's worst performing asset class, your returns are a lot higher, about 10.5%. But if you have this equally weighted strategy where you're just keeping the same proportion, that actually is giving you around 12 to 14%. So I think as I said, keep a fixed exposure and make sure you keep it fixed for a long time, and don't be, I would say, distracted by, some bull market here or some bull market there. I think most things, come to an end at every point of time.
So in response to your current suggestion, I have 2 questions. Does this also apply to rebalancing between different funds within the same geography? So if one fund has done better than the other, should I reallocate and say that I should get money off this and put it in the other one which hasn't performed well?
It depends. If it's a sector fund and something, then you can. But if it's, I would say, diversified fund, then honestly, you don't. The thing is that rebalancing incurs costs, and you want to minimize costs as much as possible, especially international funds where you have in India it's very complicated because when you redeem a fund from India, it takes 5 days to come to your bank account, and then you have to invest. So I think, I mean, if it's a sector fund or if it's a theme, then yes, you can look at intra fund rebalancing. But if it's just a simple broad market fund, then maybe you can just do it once a year and maybe keep that 30-40% allocation. Or when you are doing a rebalance once a year, you can essentially rebalance all your portfolios together.
And so when you do this rebalancing, would you recommend taking some money off the table if you've really done well over the past year or so when you're sitting down to rebalance?
No, I don't believe in sitting on cash. I have never sat on cash. In fact, I have a system. I have a personal system where whenever my bank account goes up by a certain amount, so I have a minimum amount that I keep my bank account, and whenever the amount crosses that, I transfer it straight to my mutual funds. So I don't think holding cash makes sense. I think it again, the problem with cash is that you have to time the markets. You have to know when to hold cash, when to deploy cash, and the biggest problem is that when do you deploy, how do you deploy, when do you sell. So I think market timing, in my experience, hasn't really worked out well for most people. No one can really consistently time bull markets versus bear markets, and I do think that people who try doing it, they do it because of behavioral reasons which are not right. So always be invested. If you are making money somewhere, you can maybe cut your exposure and deploy it elsewhere. But I wouldn't really hold cash unless it's an emergency fund. So maybe not in this audience, but most retail investors should have about 3 to 6 months of your expenses in an emergency fund, which can be a form of a liquid fund. But apart from that, I think at least my personal thing is that I don't really recommend people holding cash.
That's great. I can see there's a lot of clarity of thought on various aspects, which is great because typically when people are doing well, they are all over the place. And I think the last year everybody has kind of performed well, whether they've been investing directly or through mutual funds. And like you said, there has been a huge amount of traction from the retail investors. Possibly the one thing that they don't have going for them is the experience of investing or remaining invested in different market cycles.
Yeah,
and that's where I think some kind of expert advice from asset managers is very essential to bring about some amount of discipline in the investing. So that's very nice to understand these aspects of balancing, taking money off the table, how frequently, what kind of funds you should be looking at, what kind of geographies. If I may, can I ask you some basic questions about what are the options available to investors today, and what are the Indian regulations in terms of offshore taxation? Is there dual taxation? Do I pay tax in the country where I'm investing and then I again pay tax in India? How does that work?
Yeah, so in terms of there's two ways of investing abroad. One is to go directly open a brokerage account or an account in say some country outside of India, and by going directly there are certain limits in place. So the RBI does not allow more than $250,000. That's a limit. That's a yearly limit that the government imposes. So people are looking to invest abroad can only invest that amount on 1 year. Whereas if you're going through mutual funds, there is no limit like that. So you can invest unlimited amount of money if you want to go through a mutual fund structure. So that is the big difference between going directly versus going through a mutual fund. Also, mutual fund is a lot simpler because you don't have any paperwork or any administrative I think stuff that if you obviously have a wealth manager, then he can do it for you. But essentially, it has some friction today when opening our account abroad. When it comes to I would say taxation, there is no dual taxation. So investors will not be taxed twice. They will be taxed once, but it's important to understand that they won't be even if you go directly or go through a mutual fund, you will be taxed as debt, not as equity. So according to the income tax laws, international funds tends to be taxed as debt. So it's a pretty high taxation if you're looking from a 1 or 2 year investment. But if you invest for 3 years and above, then you can get benefits of indexation. What that means is you can basically inflate your purchase price by inflation. And in that case, your tax really comes down to very close to equity taxation. So I do recommend people to, invest for a minimum of 3 to 5 years time, which is what most equity investors should do. But in this case, they should essentially only take a 3 to 5 year bet, because otherwise, they'll end up paying 25-30% in taxes, which may not be required if you look at. So I think having a long-term sort of outlook is extremely important when it comes to international funds. There's also a taxation on dividends, which is something also investors cannot escape. It's around 25% of your dividends will be taxed at the federal level in the US. So it's not a lot of money. It's if you're investing in, say, a Nasdaq or an S&P, you would lose out maybe 0.5% or less than 0.5% a year on dividends. So that is something which investors should keep in mind. It doesn't really make a big difference to your overall returns, but that's something which is also an additional layer of taxation. But apart from that, there is nothing else.
Right. And you suggested somewhere in your presentation that when you make an international investment, you are basically getting exposure to two asset classes besides the equity that you invest in. It's the currency which you're getting exposure to. So that is kind of a indication where you're suggesting that one should not try to hedge that currency and remain invested in the US dollar terms. Is that right?
Yeah, exactly. So, I don't think you should hedge the currency because number one, if you see the currency movements, it's not stable. It's quite erratic. There might be some years where the currency might depreciate by 20%. Some years that my currency might appreciate by 4 or 5%. So it's pretty erratic, and the cost of hedging is also relatively on the higher side. And essentially, you are giving up on returns as well, because we have seen that because of the interest rate parity, economics 101, interest rates in India tend to be a lot higher than interest rate in the US. So to counteract that arbitrage, you need to have the INR depreciate by a small amount every year. So we've seen 2 to 4%, 5.5% in the last 10 years. But I think investors can expect 2 to 4% in depreciation. Not in that band, but over a long term so I think it makes sense to. That's one. So number two, also, I think I haven't spoken about, but currency has actually a negative correlation to Indian equity. So when Indian equity does badly, currency tends to do well. By that I mean the USD tends to do really well. So you're getting additional low correlation by having a USD in your portfolio. So what we've seen is that if you look at the S&P 500 versus the Nifty 500, the correlation is around 40-50%. But if you account for currency, it comes down to 10-15%. So I think it makes sense to have USD in your portfolio because a lot of our spending today is happening in USD.
Great. So what you're suggesting is to keep things very simple, remain invested in USD terms, try and invest to funds which have exposure to the index of the specific geography, and remain invested for a few years, try and rebalance only once a year. I guess it takes away a lot of confusion, because when people talk about international investing, they say, I don't understand, how do I go about this? So I think that's very nice that you kind of simplified things. However, for somebody who's an active trader, do you also recommend doing international investing in? So is there a permission by the RBI to invest in international derivative instruments or commodities, bitcoins, I don't know, bonds?
Yeah, you can. So once you have, once you've sent your money abroad, you can do what you want with it. So there is no regulation that this incentivizes you from buying any other asset class. So you could buy stocks, you could buy derivatives, you could buy commodities abroad. So once your money is outside, it's and you could also buy cryptocurrency with that same account. So I think it really, I think, gives you a lot more flexibility in terms of choosing what you want to buy and how you want to buy it. But I think it comes at a cost of you have to obviously report it and do all the paperwork and all that. So I think there's pros and cons of both. Plus, also I think when you're remitting abroad, there's a 6% TCS that you have to pay, which you can get it back every year. But that amount is obviously locked in for some time. So that is also something which investors should keep in mind as another sort of friction point. But yes, as I said, once you remit your money abroad, you can buy property, you can buy any other asset class which is available outside of India.
So possibly some of the more savvier investors and the more proactive ones could go out and trade on various asset classes directly also.
Yeah, absolutely. I mean, you can open an account with any US broker or say European broker, and you can trade. I mean, however, obviously, I mean, trading is something which is very risky. But if you want, you could obviously do it.
Great. So, Pratik, may I ask the audience if they have any questions?
Yeah. So there are a few questions in the chat box. So maybe I'll just answer to a few of them. So Prakash asked that we have two international funds, Nasdaq and S&P. Should I invest in either one or both? So both are really great funds, very simple funds. Nasdaq is top 100 stocks listed on the Nasdaq exchange, whereas the S&P 500 is more of a broad market fund that invests into the top 500 stocks across all exchanges. The S&P 500 is more diversified, more broad-based. It's a pure large cap fund. So you're essentially getting access to a lot more, I would say, broader based index. So it captures close to, I think, 85% of the entire US market, whereas NASDAQ is a slightly more narrower, more niche. I wouldn't say niche, but it's more tech oriented. So you'll be investing maybe 50-60% of your investments in the tech sector, which is why the Nasdaq has done a lot better, because last 10 years tech has done really well. So I would say that a lot depends on your risk profile. If you're looking at something a little bit more conservative, then the S&P 500 makes sense. Or if you want a higher exposure to tech, then Nasdaq makes sense. If you're confused, I would say 50-50 is the best strategy. So that's what I've been recommending to everyone. 50-50 makes sense because tech is obviously a great asset class to have in COVID times. And a lot of us are dependent on tech at this point in time. So that's the first question. The second question is, are there any limitations, rules from international markets? Can individuals invest in specific equities? Yes. So if you go directly, you can invest in specific equities. So if you want to buy a stake in Tesla, I have like a small investment in Tesla. That you can basically go directly and buy stocks in the US. So the only limitations are, as I said, there's a 250K limit by RBI. So you can't go beyond that when it comes to investments. So just keep that in mind. But there is no limit when it comes to your mutual fund investments.
So the 250K limit is per individual per financial year, am I right?
Yes. Yeah.
So if a person with a family of 2 or 4 members wants to do it across different, so he has a substantially good amount which he can go out and invest.
Absolutely, yeah. So if you're a family of 2, then it goes to 500K. And if a family of, but obviously you'll have to open, I think might have to open separate accounts for each person. I'm not sure how that would work, the intricacies, but yes, basically if you're investing on behalf of other people, or if you're a family, then it goes up. So it's per individual basis.
And the investment that you make, so we have another question from somebody in the audience regarding the investment that you make through index funds here in India, international index funds. That doesn't get covered under the LRS 250K, right? That's independent.
Yeah, it doesn't. That's independent of that. Yeah. So you can, that comes under domestic mutual fund laws. So that does not get included through, so a lot of our customers have already exhausted their LRS limits. Usually go and buy our funds or buy international funds outside. So yeah, it's a good point.
So if you were to buy international funds outside, you would still need to remit under LRS and then go out and buy. Otherwise, you probably need to buy from the Indian fund houses, right?
So you can remit up to 250K, and if you wanted to invest more, then you'll have to come through the mutual fund route. Yeah.
All right. Yeah. So I think, does anybody have any other question in the audience?
Yeah. So I think, I think we've answered most of the questions. I think some people had questions on the limit, and I think we've answered most of that. But yeah, I think if you have any questions, please, feel free to.
I think it was pretty clear. I think the key takeaways in your presentation summed it up very well. The basic understanding is that yes, you need to have exposure to international equities to uh, sort of de-risk your portfolio, reduce the volatility for better returns, and I guess exposure to the US dollar in terms of a currency exposure is kind of an additional icing on the cake. So, and the confusion regarding investing directly, how to make choices on stocks, I think you were pretty clear. Your suggestion is that one should go to passively managed funds and rebalance on a yearly basis. So I think that was very nice. Thank you very much for your time, Pratik. And I hope people have gathered some more insights about how they can go about investing. However, should we have anything more, can we request people at our end from my team to get in touch, and maybe somebody from your end could help out in some specific matters on investing in international markets?
Yeah, absolutely. So feel free to get in touch with me or someone from my team. I'm also available on social media. I tend to be active, so you can reach out to me there, and you can expect a reply from me very, very soon on that. So I mean, uh, happy to chat on any medium. So yeah, but yeah, thank you so much for inviting me out here, and I look forward to more of these sessions.
So before we part, and I'm not going to miss this opportunity, I'm just going to ask you, what is your overall view on the markets as of now, more specifically India, but even otherwise? Because there is a lot of talk of overheating and bond yields rising in the US, which is giving jitters to the markets. I know this is a very broad subject, but just a brief thought from your end.
Yeah, honestly, I think we're definitely in some speculative bubble, So I think, I mean, maybe not in India, but definitely in the US. There's these SPACs that are being launched every month, which are blank check companies, and there's crazy amount of speculation happening from retail investors. So you have all the attributes of some sort of speculative bubble. The only issue is that no one can really time these things. It might pop tomorrow, it might pop in 2 years' time. So I think the best strategy is to just remain invested to SIPs and not really bother. I think the best way is to just keep it simple, because what we've seen is that mutual fund outflows have been consistently negative for the last 8 months, and people have just missed out on gains because they've been scared of market valuations, and they still are scared. So I think you really don't know, and no one can really time the markets. So just stay invested, and even if there is a correction or if there is not correction, I can use that opportunity to buy more. But that's basically what I would say. I don't really have a view on the markets. I honestly don't track the markets as well. I don't spend any time reading a lot about macroeconomic indicators. But you have some attributes of it being highly speculative, and some of the asset classes like tech, for example, is extremely there is a lot of speculation, and I think retail trends are also quite strong. But hard to say. When, if there is a correction or if there's a flat sort of period or whatever it is. But I just want to say that people who are looking at the US, don't look at past returns. Nasdaq has delivered 26% CAGR for last 11 years, and that's an unrealistic expectation to have. I think even S&P 500 has done 20%. Including 5% USD INR depreciation. So I think the best way to do this is to just have really not very high expectations. So maybe expect the US markets or international markets to be the same as in India. But the beauty about this is to do it for diversification, low correlation. I think those are much better reasons than doing it because how high performance it has been in the past. So I think there is a probability of it repeating next 10 years, but it's slightly lower than what you would have seen. When I was in the US in 2009, everybody was just buying emerging markets. Today, everybody just buying, I think, international markets. Who knows what will happen in 10 years' time? But I think it's good to have both in the portfolio.
Super, Pratik. Thank you so much for your time. And we hope to have you sometime soon on something else which is more interesting, some more insights for our audience.
Sure. Thank you so much, sir. And thank you everyone for having me. And I really enjoyed this.